Hi guys, welcome back to Father and Son Investing. Before I get to today's topic, I just want to give a big thanks to all of you. Recently we hit a big milestone here at Father and Son Investing. On the last video, I made a pitiful plea to all of you to put us over the 10,000 mark. We were just about 28 viewers shy, and this was the moment when we went over 10,000. So I just want to be able to say thanks again to all of you. Now let's get on with today's topic. Today's topic will be about Treasury bills. We're going to talk about some important news events that happened during the week. What effect might those have on your Treasury bills? So let's get to it. All right, the biggest piece of news perhaps this week was the Consumer Price Index Summary release on Wednesday, July 12th. It was a good news, bad news kind of situation. What was the good news? Well, year-over-year inflation was down to 3%. That is tremendous compared to this time last year when it was running at about 9%. However, the bad news in there was that inflation month to month actually went up. In May, it was 0.1% that it had increased over the month, and for June, it was 0.2%. So good news, bad news there. But how did this news release affect Treasury bill yields? That question could be a little bit hard to answer because we don't have a lot of data since that news release on July 12th. But I'm going to take you to the U.S. Department of Treasury. In there is a daily Treasury bill rates page where you can see the daily rate on the most recently released Treasury bills. So this is not for every Treasury bill out there, just the most recent auction. I've scrolled down now where we can see all the various Treasury bills there. Remember, this applies to the most recent auction for each Treasury bill. So I'm just going to take you to the 4-week Treasury bill, and where you see it says coupon equivalent, you can look at that as the same as the investment rate that you might see on the Treasury Direct webpage. So coupon equivalent, we'll see that the day before that announcement, the 4-week Treasury bill was coming in at 5.27%. The day of the announcement, 5.27%. It went up a little bit the day after, and then it came down just a touch. So for the most part, it held steady. If we slip over to the 8-week, we'll see that again, holding steady pretty much in there. The one that changed quite a bit, really, was the 52-week Treasury bill. The day before the announcement, 5.44. It took a dip down on the 12th, the day the announcement came. It dipped even lower on the 13th and came back up a bit on the 14th. So we can see that investors here are thinking, by looking at the 52-week, that they're thinking that interest rates are probably going to be on the decline within a year, and so there's a little more interest in that 52-week Treasury bill, and thus the price went up, and so the yield went down a little bit. However, for the other Treasury bills, we see that things pretty much held steady despite that announcement on inflation, which seemed so great, 3% year over year. Now, for the next few minutes of this video, I want to turn our attention to some of the comments from the Federal Open Market Committee members, otherwise known as the Fed members. We're going to start out in San Francisco with Mary Daly, the president of the San Francisco Fed. She had this to say: we're likely to need a couple more rate hikes over the course of this year. She added, though, that while the risks of doing too little are still greater than those of overdoing it on rate hikes, the two sides are getting better in balance as the Fed nears the last part of its hiking cycle. So Mary Daly is saying she's still looking for more rate hikes. Next, we'll turn our attention to Cleveland, where the Federal Reserve Bank president there, Loretta Mester, had this to say: the economy has shown more underlying strength than anticipated earlier this year, and inflation has remained stubbornly high, with progress on core inflation stalling. Core inflation seems to be a key in many of these comments. She went on to say, in order to ensure that inflation is on a sustainable and timely path back to 2%, my view is that the funds rate will need to move up somewhat further from its current level, and then hold there for a while as we accumulate more information on how the economy is evolving. She had even more comments to make about what she saw as the current state of the economy and how that's going to affect your Treasury bill yields. She said core measures indicate that inflation is stubbornly high and broad-based. She went on to talk about the labor market as well, indicating that wage gains for Americans remain too high in a time of low productivity, which means those gains must moderate to achieve 2%. Now, the two that I mentioned already are not voting members currently of that FOMC. We'll talk about those voting members here in just a little bit. But the two that I'm going to mention now are voting members. The first one will be Christopher Waller. He is one of the Federal Reserve governors, and he had this to say this week: the robust strength of the labor market and the solid overall performance of the U.S. economy gives us room to tighten policy further. He did talk about supporting holding rates last month when they did a little skip, just to see how the economy was navigating the recent bank sector stress, but the comments were essentially that he thought those troubles were now in the rearview mirror. He went on to say, "I see no reason why the first of those 2 hikes should not occur at our meeting later this month. That is July 25th and 26th. Finally, he indicated if inflation does not continue to show progress and there are no suggestions of a significant slowdown in economic activity, then a 25 basis point hike should come sooner rather than later. A lot of people out there are thinking that the next rate hike won't happen until November after this July rate hike, that they would skip again in September. He's indicating that September is still a live possibility for another rate hike. Next, we'll turn our attention to Neil Kashkari, the Minneapolis Fed Chair President. Now, his comments are a little bit more cryptic and you have to read into them a little bit. But he noted that core inflation, there's that word again, core inflation is running stubbornly high at more than twice the Fed's 2% target rate. It was 4.8% actually, the core inflation in this latest announcement on Wednesday, July 12th. He says regarding core inflation, it's running stubbornly high, more than twice that of the Fed's 2% target. And if it is entrenched, policy rates might need to go higher, he said. So that's a little bit more cryptic, but again, they kind of have these same messages that they talk about, using the same wording, even stubbornly high core inflation. What I read into this is he's still thinking things can go higher. Why do I see that? Well, I'm going to show you the list of Fed members now. This is the list of Fed members. This is actually from May of 2023, and these do change fairly often. Nevertheless, this gives us some idea of who the voting members are. You can see that here. If they have a check mark by their name, they are a voting member. The voting members, by the way, are all the members of the Board of Governors. The New York Fed chair is always a voting member. And then the other Fed chairs from the various banks around the country take turns, essentially, being voting members. So the other nice thing about this picture here is that you can see who is on the dovish side, that's the blue side, and who is on the hawkish side, and that's the red. And these really are estimates because when they do these dot plots that I've showed you in other videos, they don't actually announce which dot belongs to which person. So I think they base this based on comments that different members of the FOMC committee have made in the recent past. What we see here is that more of them are hawkish, meaning wanting to raise rates, than the dovish folks. Now, I will tell you that the Atlanta Fed Chair, Mr. Bostic, Raphael Bostic, he did say recently in one of his comments that he thinks that they're done raising rates, or that they should be. So he's moved towards this blue category. But still, we have more in the red than in the blue, even if you look at the voting members with the check marks by their name. So what I see coming is July 25th and 26th, we're going to see a rate hike. What I also see is that inflation announcement really didn't have much effect on Treasury bill yields, except for the 52-week Treasury bill, because people are now starting to think that the Fed will, at some point this year, stop raising rates, and that there will be lowering of rates probably in 2024. We're going to wrap this video up by just showing you something that I noticed as I looked at my graph of Treasury bill yields that I keep track of. I narrowed in on the last 2 months. And what I could see here is that the 4-week Treasury bill here in blue just continues to climb through June and through July. Meanwhile, the other Treasury bills are really starting to plateau now. Why do I think that's the case? I think it's because the market also believes that there's going to be an interest rate hike. And thus, they're not necessarily interested in buying some of these longer maturity Treasury bills because they know that coming July 25th, 26th will be the announcement. There's going to be another 25 basis point hike. I think after that announcement comes, we're going to see that these other Treasury bills, besides the 4-week Treasury bill, also start to increase. That's all I have for you today. If any of this was useful for you, please give us a thumbs up, and please, please, please subscribe. We're actually well over 10,000 now. We're over 10,100 subscribers, and we owe that to you. and I made a shameless plea for it last time, so I'll go ahead and do it again and see if we can still get some more subscribers. Until next time, enjoy your investing.